Good evening
Sure.
and warm welcome to our today's faculty, Sri Amit Dhadphale sir, and all the participants present here. I myself, C. Rajesh Agrawal, on behalf of Pune branch, I welcome Amit sir and all the participants. I just briefly introduce Amit sir. He is a partner in Ernst & Young since 2018. He is into transfer pricing since last 20 years post qualification. He has diverse knowledge with respect to consultancy, compliance, and litigation in transfer pricing. He has also having diverse experience in technology tools with respect to the transfer pricing skills. He has assisted us in base erosion and profit shifting related to the compliance, such as country by country reporting, master file, and related advisory. Not only these, friends, he has diverse professional experience in setting up of the compliance transfer pricing mechanism, developing defense strategies for transfer pricing audits, managing the transfer pricing compliances, 3-tier documentation, CbCR, MF, local file, TP studies, and all. He has represented large number of clients before the revenue authorities during their transfer pricing audits and appeals before different authorities, including High Court. He has been actively advising clients on alternative dispute resolution mechanism such as MAP, APS, and SHR. He has also served clients on the BEPS compliance and related advisory. Amit ji has been serving various inbound and outbound clients from various industries such as engineering, automobile, and software. I like to share some case studies. He has assisted in strategizing a complex advanced pricing agreement for a large Indian subsidiary of a Sweden group. He has assisted a large Indian subsidiary of a US MNC in APS for management service fees, exports, etc., which included bilateral site visits, etc. He has also strategized and completed the BEPS compliances under country by country reporting and master file for a large Indian MNCs. He has diverse experience in global transfer pricing policy for a unicorn Indian startup. With this brief introduction, I request Amit ji to take a charge of the session.
Thank you, Rajesh ji, and warm welcome to everyone. Good evening, and I look forward to an interactive session. I have a hard close at 7. We'll try to finish maybe 5-10 minutes before that, so that if there are any questions, but feel free to put up your questions in the chat box. My only request is don't put your questions in Q&A box, because then there are some points that come in chat box, some come in Q&A, and then that is confusing. So from that perspective, if I can request everyone to put up their questions or whatever comments they have in the chat box itself.
Great.
And the better the interactions we have, the better learning we have. That's what I personally feel. So
Yes.
With that, maybe let me dive into the topic straight away. So what we are covering today is basically 3-tier TP documentation and basically the nuances of Form 3CB. And why it is particularly important is because there are these compliances that are required. That's a new age compliance, although it is there for last few years, but still how these are used by authorities is something that we have to see. We have done compliances under country by country reporting. We have done compliances under master file, but how these are used by authorities is something that we are yet to see. Point number 1. But do we have some insights in terms of how the authorities are going to use these, and is there any guidance by OECD, is also something that we will discuss today. We will also discuss, what are the compliance requirements under law, whether there are any penalties, and if yes, what are those penalties, and we'll try to get into what kind of forms are required to comply with these. And much before that, let us get into what is covered by this action plan 13. And maybe before that, we need to also understand, and I'm sure most of us are aware about what is BEPS, but a quick touch upon what is BEPS. So BEPS is base erosion and profit shifting. So there was a point of time where both developed as well as developing countries were feeling the heat, where there was a phenomena called economic double non-taxation. So all of us are aware that there are these treaties which aim at avoiding double taxation. But what is this animal called double non-taxation? This is a situation where the profits are the tax base is eroded and the profits are shifted to a tax haven. We call it Cayman Island, call it Mauritius. We have various names that we are aware. And therefore, both developing as well as developed countries approached OECD and requested OECD to come up with a guidance. Now, this guidance was required for multiple aspects. It was for international taxation. So transfer pricing was one part of it. It is not that transfer pricing is completely covered. The entire action plans are, focused on transfer pricing. However, also important to note that 4 out of 15 action plans that OECD identified have a transfer pricing implication. And why was OECD required to cover 15 action plans? Because the timing when the tax laws were incorporated was different and the manner of business was different. So when the tax laws were incorporated, the business was more of brick and mortar. However, with the digitization of economy and with the globalization by the MNEs, the approaches changed, and that basically required a relook at the global international taxation. And therefore, OECD came up with these 15 action plans. And if we try to categorize them, they were basically focused on, say, industry specification, which is basically addressing digital economy. So we have seen cases where we have equalization levy that is introduced by Indian government. There is Google tax that is introduced by UK government, so on and so forth. So basically, you have a situation where the physical presence is not important, although you're exploiting the territory to get more business. And therefore, the nexus of the taxation with physical presence is something that was challenged. And therefore, this guidance came up. Then we have coherence, for which there are these various action plans that came up. Basically, hybrid mismatch, strengthening the CFC rules, limiting the base erosion via interest deduction, which is basically thin capitalization kind of guidance, and then countering the harmful tax practices, which I talked about some time back. Then was the next category or next bucket of objective, which basically looked at providing more guidance on substance. So preventing the treaty abuse, preventing the artificial avoidance of permanent establishment, are some of the things. And the highlighted one are action plans 8 to 10, which collectively are called as with the aim of aligning the TP outcome with value creation. So you would agree that intangibles are some of the transfer pricing transactions, which are very, very litigious. More importantly, there is not much of guidance that is available under the tax laws in terms of the transfer pricing aspects for these intangibles. Similarly, there was this capitalist view that higher the risk, higher the reward, or the intellectual property belongs to someone who has funded the entire development, is something that needed a revisit, and therefore this action plan 9 came. And then action plan 10, in my view, is still some kind of work in progress, but it covered high risk transaction, especially the intra-group services, because that is a transaction that faced significant litigation globally. Then if we look at transparency and certainty, under this category were these 3 action plans. Action plan 11, which is measuring and monitoring BEPS, action plan 12, which is mandatory disclosure rules, but action plan 13 again was focused on transfer pricing. And there, from a transparency perspective, OECD suggested that you should come up with 3-tier documentation. And let me tell you, whatever OECD says will not become the law of land until that guidance or that recommendation is adopted in domestic law. And let me share with you, there are multiple countries, all the OECD member countries and countries which are observers to OECD, such as India, have adopted this 3-tier documentation requirement. And we'll talk about what is that. But let me give you an example. When you go for a TP audit, look at it from the TPO's perspective. You are telling them that you are providing this kind of service and you're following this kind of pricing mechanism. Now the transfer pricing officer, to better appreciate the TP, overall TP arrangement, needs to understand the big picture, needs to understand the 360-degree perspective, needs to understand overall value chain, needs to understand who is contributing what. And all of these details were not available, which was creating some challenge on the transparency, which was in a way leading to some kind of uncertainty. And therefore, to better provide the transparency from a TP perspective, and that too from a BEPS perspective. So the objective of all these disclosures is to arrest the risk of base erosion and profit shifting. Therefore, this action plan 13 came into picture. And then from execution standpoint, we have this action plan 15. So basically these 15 action plans were identified by OECD, and action plan 13 is something that we are going to discuss today, which basically aims at certainty and transparency. So let us understand what are these 3-tier documentation requirements. We have someone who has raised hand. So if you have a question, maybe you could put it in the chat, or Rajesh ji, we allow people to ask questions by unmuting themselves.
सर जर तुम्ही म्हणत असाल तर आपण अलाउ करू शकतो कसंही.
So we can allow, provided we are able to. So yeah, here there is Meha Desai who has raised hand. If she wants to ask questions, she can ask.
Meha madam.
No, thanks. I'll ask later.
Okay, fine. So maybe you can mute yourself, Meha. So let's look at what are these requirements. So one is country by country reporting, and let me share with you what is the objective, or what is it that OECD is looking at by covering these 3. And from these, the simplest one, if you ask me, is the last one that we have, which is local file, which is equal to our TP documentation, which covers the actual transactions undertaken, the pricing mechanism, the benchmarking, and the conclusion on arm's length. But for these, you also need to have the big picture. And big picture, if you ask me, can be categorized under 2 buckets. One is quantitative, which is covered by country reporting. I will call it CbCR going forward. And there is a lot of qualitative information that needs to be looked at.
Hello. Huh?
Somebody has unmuted.
बोलो ना एक बार नाम बोलो.
Can you mute yourself? I think somebody is speaking.
Yes sir, sorry.
Yeah, okay. So Jayesh, you have asked a question why India is not a member of OECD. So there is no restriction or something, but basically, it is elective. and India doesn't want to get governed by, because see, if you are a OECD member, then you basically have to abide by all the guidance that OECD comes up with. And whereas India, typically being a developing country, has certain views which may not be aligned to OECD, especially from a P attribution standpoint, and so on and so forth. There are multiple areas where India does not agree completely with OECD. So India has chosen to be rather an observer rather than a member of OECD. However, India is part of G20, and rather this year we are chairing the G20 summit. But yes, India is not part of OECD. India is an observer. So coming to this CbCR is basically a lot of quantitative data, and we will talk about what that exactly covers. But basically, see, you need to understand the big picture numerically also. What is global profit? Which are the countries which are contributing to global profit? What is the tax paid by the group in various countries? What is the distribution of assets throughout the group? What is the distribution of employees throughout the group? So on and so forth. And we'll cover all of that in greater details. But basically, if you want to just remember, CbCR is quantitative blueprint of the group. Whereas master file, as the term suggests, master is the blueprint, which is a qualitative blueprint, which means that it will cover the TP policies, it will cover the strategy from a or global arrangement from a intangible standpoint, financial transaction related transactions. It will talk about, which are the what are the 5 top products that the group has, what is the supply chain, which are the drivers of business, so on and so forth. So all qualitative information is something that gets covered under master file. So CbCR, TP document. So these are 3 compliance requirements which put together basically cover this 3-tier documentation. So what is the objective? Objective is to provide the tax administration with the information to conduct the informed TP risk assessment. And please remember, this is TP risk assessment, not TP audit. So CbCR and master file can be used only to identify BEPS risk. And these 2 documents alone cannot be the basis for someone to propose an adjustment. Then obviously ensuring that the taxpayers provide appropriate consideration to TP requirement. And last but not the least, providing the tax administration with adequate information to conduct a thorough TP audit. Maybe I'll take a pause here. There are some questions. Okay, so Chetan, we will talk about this, how TP will be monitored for Indian entity transacting outside India. We'll talk about that, and that is what we rather plan to cover. So maybe bear with me for some time. We will talk all of that, Chetan. Please hold your questions. Maybe bear with me. We will cover all these points. So let me move to what are the Indian TP regulations, and to answer, maybe the answer is very much here. So so India has adopted all the recommendations by OECD in Action Plan 13, and therefore this CbCR master file are very much part of Indian TP regulations. Okay, so you need to file the CbCR, and who has to file, when it has to be filed, all these questions I'm going to answer. But to give an answer at a high level, India has adopted all these 3-tier documentation requirements. So India requires you to look at CbCR compliance. India requires you to look at master file compliance, and obviously TP documentation was always there. And in addition to these 3-tier documentation, India has an additional animal called accountant's report, and this is basically this is a traditional This is, some people call it TP audit report, but this is not really audit report, but it is an accountant's report. And what is the difference? We'll discuss that in greater detail in some time. But this is certification by an accountant in terms of what are the transactions, what is the value, what is the method that has been used, what is the arm's length price that has been computed, and whether all these details provide a true and correct view of the information that has been provided. So we will move to what are the requirements, and so rather let us look at what are the penalties. So for Form 3CEB, it has to be filed by every person who has entered into international transaction or specified domestic transaction. Specified domestic transaction is basically a transaction by the unit or entity enjoying tax holiday with another entity or differential tax rate. So we have this 15% tax rate 115 BAB entity. So that is something that also gets covered. The threshold for that is 20 crore rupees. So even if you have transaction which is with a related party by the tax holiday enjoying unit, but if that aggregate value of those transactions is less than 20 crore, then SDT provisions don't apply. So this accountant's report has to be obtained and it has to be filed electronically 1 month prior to the due date for filing return of income. As you know, the due date for cases where TP is applicable is 30th November. So 1 month prior to that, so 31st October of every year is something where you have to obtain. And please note that there is no threshold. So even if you have 1 rupee of international transaction, and what is international transaction? Well, all of you would be aware, but a transaction between two associated enterprises, and there is a long definition of associated enterprise, but basically the related parties where there is control, management or participation in capital. These are the 3 broad categories, and then there are various examples that have been provided. But if you have that kind of relationship, so if you have a cross-border transaction between the 2 associated enterprises, either or both of these are non-resident, then transfer pricing gets triggered. So somebody had asked that if Indian entity has a transaction with its overseas related party, then obviously this Form 3CB is going to get triggered, and there is no threshold for this. Then let us look at what are the contents of Form 3CB. But and we will have more detailed discussion about nuances. I'm assuming here that you have worked on transfer pricing or you have an idea about Form 3CB. We will talk about the nuances in greater detail. But basically, this 3CB is a report by an accountant, typically a chartered accountant under Section 288 1 that has been covered. And then 3CB has annexures which cover Part A, B, and C. Part A are taxpayer particulars, Part B are international transaction, Part C covers domestic transaction. So that's overall coverage of Form 3CB. And like I mentioned, you have to cover, you have to basically cover in these annexures, you have to cover what is the name of related party, what is the transaction, what is the price at which the transaction has been entered into, what is the arm's length price that is computed, and which method has been used. So basically that all gets covered under various clauses under Form 3CB. Now let's talk about CbCR. So CbCR is country by country reporting. This CbCR, let me tell you, has to be filed by the ultimate parent of the multinational group. They have called it international group, IG or international group. So what is international group? Where there is, where the consolidation happens, whether that entity is listed or otherwise. But if the group, so the ultimate parent, which is at the top of the pyramid of the organization chart, is the entity which is identified as ultimate parent. That parent, whether listed or otherwise, if that parent was required to prepare consolidation of consolidated accounts, if they were listed, then that becomes the ultimate parent. And that ultimate parent has to file the form 3C, has to file the CbCR in that parent's country with the tax authority. And that CbCR will be available to the tax authorities of various countries with which that group has transactions under automatic exchange of information agreement. So there are separate agreements, and that again is a guidance provided by OECD. This is beyond your double taxation avoidance agreement, under which the information will be shared, especially with respect to CbCR, between the tax authorities. So if I give you an example, let's say I have a group that I'm working, and that group is, let's say, headquartered in Canada. Then the ultimate parent of the group, assuming that it is in Canada, will file that CbCR with Canadian authority. And if India has a transaction with that group, then Indian authority will get that CbCR through automatic exchange of information from the Canadian tax authority. So every subsidiary need not file the CbCR in the respective country. However, there is an exception to that, and let me explain. So, okay, so India has adopted CbCR. So obviously, who has to file? This is the answer to that. So obviously, if you are the Indian parent, if this is Indian group, say for example Tata Motors, or you take maybe Infosys. So Infosys is the ultimate parent, which is an Indian parent, and they have international presence. Then Infosys will file the CbCR in form 3CEAD with the Indian tax authority. And then let's say Infosys has transactions with, say, UK. Then UK tax authority cannot ask it from Infosys UK. They can ask it from Indian tax authority, provided obviously India has signed a contract or agreement for automatic exchange of information with respect to CbCR. So Indian parent has to file. Then there is a concept that has been introduced, which is called alternate reporting entity. So let us say that I have a group which is, say, headquartered, for the sake of discussion, in, say, Netherlands. And Netherlands does not have the CbCR filing requirement. If that is the case, then the tax authorities would ask all the subsidiaries of Netherlands to provide the CbCR details. And therefore, Netherlands, while they are not required to file the CbCR as per, let's say, the Dutch laws, they may nominate an alternate reporting entity, say in UK, to basically file CbCR for and on behalf of group and for and on behalf of this. And then the report will be available under automatic exchange of information. So either the Indian parent or the alternate reporting entity, if that entity is resident in India. So it may happen that that Netherlands entity may appoint India as alternate reporting. Because India is now alternate reporting entity, India will file with Indian authority. And last point is another important, interesting point, is that even if the Indian entity, which is a constituent entity, which is subsidiary, which is neither parent nor alternate reporting, but under various circumstances, Indian subsidiary also may be required to file the CbCR with the Indian tax authority. If the parent is not obliged, they have not appointed any alternate reporting entity where India does not have agreement for exchange of information, or where there has been systemic failure of the country or territory, and such failure is intimated to the constituent entity. So basically, the tax authorities are saying, if your parent is compliant and we are getting the data, then we don't need it from you. But if your parent is either not required to file, or they have filed, but we do not have the access to that data through the automatic exchange of information, or if there is a willful systemic failure by your parent, then we will catch hold of you and you will have to provide us the details. Now, what is the due date for this filing? The due date is 12 months from the end of accounting year. So if it is Indian parent, then, and assuming that it is 31st March 23 as the year ending, then by 31st March 24, this Indian parent will have to file the CbCR with the Indian tax authorities. Then there is something called CbCR notification. So let's say that you have an Indian constituent entity of the international group of which parent entity is not resident. So let's say it is a US group of which you have a subsidiary in India. Then India will not file Form 3C, will not file Form 3CEAD, which is basically CbCR, but Indian subsidiary will communicate to tax authority that, hey, I am part of this ABC US group and my parent is doing the compliance under CbCR. There is no threshold that has been prescribed for this CbCR notification, but obviously where the CbCR as a requirement is there, then this will, and then is any and every group required to file? The answer is no. The global threshold is 750 million euro for the preceding previous year, where India has come up with 6,400, which is approximately similar to euro 750 million. Where, so if the so let me take an example. You are looking at financial year 22-23. So financial year 22-23 with, and let's say this is Indian parent. Then you will look at the consolidated group turnover for financial year 21-22, and if that exceeds 6,400 crore rupees, then this entity will be required to file the Form 3CEAD, that is CbCR, in India, and the due date for that will be 1 year down the line, which is 31st March 24. We are talking of financial year 22-23. Now, if you are a subsidiary and your parent and you're not caught under this exception, then 2 months prior to the due date for filing CbCR, you will communicate that you're part of this, your constituent entity, or you're part of this particular group. So let me take an example. Let's say India is a subsidiary of, let's say, a Canadian group. The Canadian group follows calendar year as the accounting year. So they have closed the year recently, which was, let's say, the year ended 31st December 22. Then the due date for them also is 12 months, which is 31st December 23. 2 months prior to that, that is 31st October 23. So by 31st October 23, the Indian constituent entity will only communicate to the authority that I'm part of this group and my group is doing the compliances. I'll take a pause. If you have any questions, I will also look at the chat. So question is PE in India required to file notification, intimation, intimating name of, yes, P is a person, so P also is a constituent. Sudeep. Yes, Sudeep. Okay. Any other questions in the meantime? Okay. So let's move to the next part. So what is this framework? I think I talked about all of this. So if Indian company is the parent entity, Sudhi, if you have a question, you can unmute yourself. Ma'am, would that be allowed? Would you need to unmute her, or how is it? She's raising hand but not able to speak.
Thank you so much, Amit.
Yeah. Okay.
So I just had this question. Now, if there is an Indian group that you mentioned, for example, Tata, and we are required to do CbCR filings, etc. So it has a lot of group entities in India. One of them is also a PE. in India of say a UK entity, it has a P in India. My question is, all these subsidiaries will file, and I'm forgetting the exact name of the form, but we file an intimation saying, okay, this particular entity in India is going to do all the filings for the group, alternate reporting entity. In that case, is the
No,
P
no, no,
also
no, no, no. I
required?
think, okay. So maybe, Sudhi, hold your question. I think you're talking about Indian headquartered group.
Correct.
Yeah.
Yes.
So if it is Indian headquartered group, then the ultimate parent will file the CbCR. Rest of the entities will file only notification. Rest of the group companies.
Yes.
Okay. And if you have more than one group companies in India, you
Yes.
can designate one entity to file the notification.
Yes, but all the other entities also file an intimation saying, okay, this particular entity will do the master file and CbCR,
This
right?
is not master file. This is right now about CbCR.
So the group entities are not required. Oh, that is only for ultimate parent entity. The other entities need not file the intimation.
Exactly.
Okay.
Okay. So,
Okay.
okay. So let's go through this flowchart so that you have the clarity. So Indian company is a parent, right? And it is required to prepare consolidated financial statements, and the turnover is more than, you have to evaluate whether the turnover is more than 6,400 crore, then you have to file CbCR. If it is not, then you have to check whether Indian entity is a alternate reporting entity of the group. If the answer is yes, then again you have to file. If the answer is no, you have to check these 286.4 related exceptions, which is systemic failure, etc., etc. If the answer is no, then notify the details of parent company in Form 3CE-AC 2 months prior to the due date. If the answer is yes, then parent, you have to check whether parent has designated any alternate reporting entity. If the answer is no, then check whether there is more than one entity. If the answer is yes, then notify details of designated entity to the tax authority and then file the notification. If you the answer is that there is this designation that has happened, then you will have to do the notification requirement. So these are the two situations: this one no, this yes, this yes. So three situations where you are required to file Form 3CEAD, 3CEAD, and there are other cases where you have to file 3CEAC. So that's, Sudhir, does this answer your question now?
Yes. I think I got confused with master file. Yes.
Yeah. Okay. So let's move to the contents of CbCR. Maybe you can, yeah, thanks. If anyone else has questions, you can ask the questions in the chat box while we are progressing. But let's move to contents of CbCR. Like I mentioned, these are quantitative contents. So basically it will cover revenues. And by the way, this is qua the jurisdiction. So if you have 4 entities in, let's say, UK, then you will give all these details for all 4 entities put together, because you're looking at the tax base erosion qua the tax jurisdiction. Okay. So therefore, so what are the details? They're asking you for revenues, which are total revenues of that jurisdiction, split into unrelated party and related party. What is the profit before income tax? What is the cash tax paid, including withholding tax that has been withheld? Then what is the current tax accrual? So this is cash tax paid, this is tax accrued. Then what is the stated capital? What are the accumulated earning? What are the tangible assets other than cash and cash equivalent? And what is the number of employees? All of these details, how these will be used, we will discuss that in a bit. And then this table 2 basically covers what are the main business activities, and that has to be given qua jurisdiction, qua the entity also. So if you have UK as entity and there are 3 group companies, for each entity you have to give the details. And then there is table 3, which basically covers notes to this. So these are the contents of CbCR. Okay. Cash tax and tax accrual column. See, why these details are important. So let me talk about that. So let's talk of revenues now, and see, what are we looking at? We are looking at a BEPS kind of risk. That is to say, a possible base erosion and profit shifting through transfer pricing. So what will you try to see? what is the total turnover? Out of that, if you have major turnover with related party, then obviously there is a possibility of you controlling the profitability of that entity, and probably there could be a there could be a BEPS risk. So this is one aspect. Then let us look at profit before income tax. So if I have significant amount of related party transaction and profit before income tax is very low, or if there is a loss, then again there is a BEPS risk, because that could be arising on account of mispricing, underpricing. Then let's talk of cash tax paid. So this is actual cash tax paid, and obviously withholding it has to be included in cash tax paid, because that reduces your fund flow. And then current tax accrual is there. Now, why these two columns? Because there can be some schemes of deferral of the tax accrual, which could be used to basically reduce the tax incidence. And therefore what the authorities are looking at is, what is the tax that you have accrued and what is the tax you have actually paid, because this might lead to some kind of BEPS risk. Then obviously stated capital, accumulated earning are details to corroborate the substance in the entity. Now let's look at this tangible asset other than cash and cash equivalent. And let's take an example. Let's say you have a Mauritian paper company which is the owner of intangible. So now you have an entity which has significant related party transaction, very high profit that they have earned, zero or very low cash tax paid, zero or very low current tax paid, very low stated capital, but very high accumulated earning. These are two only. How two? One is a security person, one is an admin person. Now, this is a classic example where there is a BEPS risk, and that is what authorities are going to look at. So from all these numbers that you are giving, authorities are going to compute various ratios, and I have covered some of the examples of ratios in subsequent slides. But and then they are going to corroborate that with the activity in the jurisdiction, and then they are trying to evaluate whether this kind of financial data along with the main business activity leads to some kind of BEPS risk. So again, I will take a pause if there are any questions, else we can proceed.
Svetali, can you
Yes, you can ask. Hello.
Sudhi Tiwari?
Just एक minute.
And Sudhi has a question. Sudhi, you can type the question if you want, or you can ask by unmuting yourself.
Yeah, I am unmuted, sir.
Yes, thank you, Amit. Amit, my question is, when we fill the details in the slide that you were just discussing, revenue, EBITDA, PBT, we mostly rely on the audited or published financials for the year. My query comes in when we are reporting the cash tax that needs to be paid. What is the amount? Can you hear me, Amit?
That data, see, yeah, I can hear you.
So my question is, when we report the cash tax paid, what number, since I'm talking because I have faced this issue, should we pick up the number from the cash flow statement in the published financials, or should we go back to the tax return that was filed on 30th November later and look at the tax that is paid there? That is my first question. And
So,
in the accrual also, should we rely on financials, or should we look at the total tax payable as per tax return?
okay. So let me give you an answer. See, here you need not look at tax return. You have to look at consolidated financial accounts, and beyond that, you have to look at internal data. So you will not wait, because see, if you talk about November, then the due date itself for CbCR to be filed is 31st March of next year. So you can't wait for, you need not wait. Let me put it this way, for a return to be filed. But in the books, there is actual cash payment. There are various challenges. And by the way, if you're talking about income tax return, that is for a particular year, but during the year, you may have paid tax for earlier years also, right? Under either self-assessment or tax on account of assessment, etc. So cash tax paid is actual tax paid. And for that, the data has to be kept separately by the taxpayer. Whereas accrual is something that you will look at on the basis of annual accounts. So revenues, related party, unrelated party will all be available in the annual accounts. Profit will be available. Cash tax has to be actually digged from the details, from the accounts that the company has. Accrual, current tax accrual will be from the books of account. Capital accumulated earning are from books of account. Tangible assets are from books of account. Number of employees will come from outside. So that is what I would say.
Okay, and MAT
Satish goes
credit
through this.
and MAT credit will be included in cash tax paid, Amit?
Yes,
Okay. Okay. Thank you.
if you have utilized the MAT credit.
Yes, if I've utilized. Yes, I'm
Yeah.
doing it. Yeah.
Yeah.
Okay. 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 Thank you.
Satish has a query. Is advance tax also? Of course, Satish, advance tax also will be considered as cash tax paid. Yeah. Okay, maybe we will move to Bhakti Marathe has a question. Bhakti, go ahead.
Yeah, hi Amit.
Yes.
Yes, so in this cash tax paid, it includes CIT and WHT. And if I'm not wrong,
Yes.
WHT for previous year is also included. So how these tax authorities uses this tax payment? I mean, it is again, it is percentage they may have calculate that this is the profit and this is the tax paid. But if it is a mixture of, previous year taxes as well, and it also has a net effect of refund also. I mean, when we
Yes,
are paying
it
cash.
can have. See, they are basically trying to look at whether there is a significant gap between tax paid and tax accrual. So this
Okay.
is a macro thing. See, they are not looking at doing a one-to-one correlation because this is not a TP this is not a TP assessment. You are giving the details which probably will give you an idea whether there is a base erosion and profit shifting. So please remember, this is not a corporate tax assessment, nor this is a TP assessment. You are trying to look at triggers which could lead to some kind of BPS risk. And therefore, they are asking for these details. Obviously, there will be some details which will be at a macro level. There may be, I may have an accrual for the year and I may pay the actual tax by way of self-assessment tax in the next year. But overall, over a period of time, things will balance out, right? So
Right.
they are trying to look at whether this accrual versus cash tax paid, there is a significant gap, thereby evaluating whether there is some kind of BPS risk. So this is not corporate tax assessment to tally each pie, each rupee, and tally it for the year, so on and so forth. I hope this clarifies your question.
Yes, sure. Thank you.
Okay. So we will move ahead. Now let's talk about master file. So like I said sometime back, master file is the qualitative blueprint of the group. And, who has to file this master file? Now, for CbCR, sometime back, I told you that the consolidated group turnover has to be more than 6,400 crore rupees, and that too for preceding year. Whereas for master file, you have to look at the consolidated group turnover for the current year. And if it is more than 500 crore rupees, this is condition 1. And if the aggregate value of international transaction as per the books of account exceeds 50 crore rupees, or the intellectual property related transactions if they exceed 10 crore rupees. So if you have 500 crore and 50 crore, then also master file is applicable. If you have 500 crore and 10 crore, then also master file is applicable. If you have 500 crores but 40 crores and no 10 crores, then master file will not apply. So that is what is the summary of requirement. Now, master file has to be filed in form 3CEAA. We talked about threshold. Wherever you're a constituent entity of the group, okay, then whether or not these thresholds are met, you have to at least fill up the part A of this form 3CEAA, which basically is a very standard information which covers what is the name of your group, which are the entities in India, what is the PAN of these entities, so on and so forth. So these are very basic details that you have. And then the due date is on or before the due date for furnishing return of income. Now, this master file also has to be filed with Director General Risk Assessment. Maybe I missed to, and we will cover that in which ways. But you are not filing the CbCR or master file with your jurisdictional assessing officer. You are filing this with you're filing it with Director General Risk Assessment. Why? Because this is the group, this is the designated authority which is going to do the evaluation, and how they will do that, we will talk about that. But basically, you will file the master file as well as CbCR earlier forms with this DGRA, that is Director General Risk Assessment, and you have to electronically file this master file. CbCR also has to be electronically filed. But the due date for CbCR is 1 year after the end of accounting year. Here, the master file has to be filed on or before the due date for furnishing return. And if you have more than one constituent entity, and somebody had asked this question, then maybe so master file is for the group. If let's say the group is a US group and they have 3 entities, then master file by itself, by name itself, is one document. Now, instead of making all 3 entities file one copy, you can designate one entity, and that one entity could file a designation saying that I've been designated by these three companies, and I will be filing the master file for the group on behalf of these 3 entities. And obviously, the due date is 30 days prior to the due date for filing master file. So let's take the year, financial year 22-23. The due date for furnishing return of income is 30th November. So master file has to be filed before that. If you have multiple entities, then the entity which is designated has to communicate the designation 30 days prior to the due date, which is basically on or before 1st of October, because 30 days, October has 31 days. So on or before 1st of October, or for practical purposes, you can say 30th September. So that is what is the scheme of master file. Let me take you through the flowchart so that you have a good understanding. So what we are saying is, does the group has consolidated revenue of more than 500 crore rupees? If the answer is yes, then you have to look at these 2 conditions, whether, and this and these 2 put together is and. So whether the aggregate value of international transaction is 50 crore rupees, or the intangible related transaction is aggregating to 10 crore rupees. If the answer is yes, you have to prepare and furnish master file. If the answer is no, if turnover is no, then furnish only part A. Again, if the thresholds are not met, furnish only part A. But if you are required to prepare and file the entire master file, then you have to evaluate whether you have more than one constituent entity. If yes, then do the designation and file. If no, then furnish part A. And that is how you complete the master file related compliances. Then let us look at what are the contents of master file. So basically, these are broad buckets that I have put up, but and you have clauses for each of the questions. But what are these broad buckets? So the master file, like I mentioned, is a qualitative blueprint. So obviously you need to understand what is organization structure. Then you need to understand business description. There is a separate focus on intangibles. Then there is a separate focus on financial activities, and then financial and tax positions. So under organize, and the ones that I have highlighted in yellow are basically the additional requirements over and above OECD requirement by Indian TP regulation. So India has adopted as it is, but India still wants some more details. So the OECD requirement is cover legal status and ownership by way of organization structure. But India says, no, we want the list of all entities along with their addresses. Then what is the business description related data? What is the nature of business? What are the important drivers? Supply chain related details for 5 largest products or services generating more than 5% of consolidated group revenue. What are the main geographical markets for the group? Description of important service arrangement. This is again India specific requirement. India says we want the functional analysis for the entities that contribute at least 10% of the revenue or asset or profit of the group. Then what is the TP policy for service cost application, etc., and intra-group services, and whether there are any business restructuring or acquisitions that have happened during the financial year. Then intangible related, what is overall strategy? Again, India says, no, we are not happy only with strategy. We want a list of all entities that are engaged in development and management of intangible. Then list of intangibles that are owned by the group and legal owner related names. List of important intangible cost, TP policy, details of important transfers, and then financial arrangement and financial data. One more important point is they want you to file annual consolidated financial statement. They also want you to communicate whether there are any unilateral advance pricing agreements because that may have an impact of base erosion profit shifting, because what is agreed under a unilateral APA may not be acceptable to the authorities of the other country. So that is why they want to look at unilateral APA. And if you ask me, therefore, many of my clients are now insisting that we want to explore bilateral APA as opposed to a unilateral APA. Yeah, so maybe I'll take a pause here because we have finished master file related requirements. If you have any questions, happy to answer. You can either raise hand, unmute yourself, or ask the questions in the chat box. Okay, assuming that there are no questions, I'll move ahead. Let's talk about TP documentation. This is something that all of us are very well aware. So I'll not spend too much of time. This is basically 92D1 documentation read with rule PEND. This is your local file, which has been there for a long time, which is basically your TP study report, TP documentation. Basically, this has to be maintained on an annual basis. There is no prescribed form. This is not required to be furnished with the tax authorities, but the data has to be maintained by the due date for filing form 3CEB, and this is not required to be filed. But if the authorities requisition by way of notice under section 92D3, then as per the recent budget amendment, it has to be filed within 10 days from the notice, but you can request for extension for another 30 days. And every person who has entered into an international transaction has to keep and maintain the details, but there is an aggregate threshold of 1 crore rupees to maintain the entire documentation. But the proviso clearly says that if it is less than 1 crore rupees, then also you have to maintain such a documentation with which you are able to prove that the income is computed having regard to arm's length price, and the due date for maintaining is before the due date for furnishing return of income. So that is a broad summary of TP documentation requirement. I think content is something that all of us are aware. Basically, you cover organization structure, industry overview, what are the transactions, what is the comparability and functional analysis, what are the background of documents, and then you look at selection of most appropriate method, application of most appropriate method by way of benchmarking, talking about assumption strategies, and then if you have any supporting documentation. So that completes the third tier, which is your local TP documentation. Again, I'll take a pause if there are any questions. Or maybe let me, whatever we have discussed, let us try to look at what is the compliance calendar. So this is Indian headquarter group, okay, for financial year 22-23. Because it is 22-23 and the accounting year is 23, we are saying that the CbCR will have to be filed by 31st March because it is 31st March 24, because you get 12 months from the end of accounting year. So CbCR 31st March 24. Due date for filing return of income 30th November. That is the time when you have to file the master file also, because for master file, the due date is by the date for furnishing return of income. However, the TP certification has to be 1 month prior to that. And the reason for that is, if you see all tax audit reports, all the audit reports which have an impact on computation of income are to be furnished 1 month prior to the due date for return of income, because the government is looking at automating the return of income. And for that, whatever are the inputs on the basis of certificates or certified details, these they are looking at completing 1 month prior. So the due date for 3CB as well as TP study as well as master file designation is 31st October. And similarly for 23-24, the 3CB will be due by 31st October 24, TP study will be 31st October 24, the master file will be designation will be due by 31st October 24, actual master file by 30th November 24, and CbCR 31st March 25. So that is the compliance calendar that you have. SDT Chetan is a detailed topic, okay, and I explained that maybe I don't know whether you joined late, but basically SDT is specified domestic transaction which are within India, but these are transactions that are undertaken by either a unit that enjoys some kind of tax holiday or an entity which enjoys differential tax rate, which is say 15% tax rate. So then you have and where the aggregate value of these transactions exceed 20 crore rupees, then you have SDT that comes into picture. I hope I have answered. There is another question. What are the consequences if director of a private limited company having voting right in any of the foreign entity with whom there are a few transactions, but due to non-information from director, private limited has not complied TP requirement? So I will talk about what are the TP penalties, Yatin Kumar. You will get the answer to that. So this is basically, whatever is the reason, I'm not looking at the reason. I'm saying you have not done the TP compliances. So what are the penalties? We will talk about them in a bit. So let's say if you are Indian constituent entity, so the headquarter is abroad, your constituent entity, everything remains the same. Basically, there is a CBC notification related date, and that is what we have covered. So I'll not spend time on this slide. Let's look at what are the penalties, and that is basically the question asked by someone. So for Form 3C EB, the penalty is 1 lakh rupees. For 3CB and TP documentation, it says that penalty for failure to maintain and for maintain documentation prescribed under 92D1 and 92D2, 2% of value of international transaction. Failure to report a transaction, which is 3CB related, again 2% of value of international transaction. And failure to maintain and, if you have maintained and furnished incorrect information on document, then also it is 2%. So therefore, the penalty can range from 2% to 6% because there are these 3 levels of penalty. By the way, it can become 8% also if the authorities ask you to furnish the information and you don't furnish. There is another 2% level of penalty. For master file, the penalty is 5 lakh rupees. And for CbCR, draconian penalty, which is in a graded way, but it ranges from rupees 5,000 to 50,000 per day for either for non-furnishing of CBC report or non-submission of required information as and when requisitioned by the authorities. Let's look at what are the penalties. So this slide covers the penalties where there is a TP adjustment that has happened. So you have a situation in the past, the penalty was under 271(1)(c), right? So wherever there is an adjustment by the TPO to your transaction, then there is a potential where the penalty could be levied for concealing the particulars of income, and the penalty was 100% to 300% of tax sought to be evaded. But all of that is replaced from AY 17 and 18 by section 278, which says that if there is a TP adjustment and you did not get Form 3CB and you did not have TP documentation, then the penalty is 2% of the tax on TP adjustment. But if you have maintained Form 3CB, but you did not have TP documentation, then 50% of the tax on TP adjustment, which in a way means that if I have maintained the TP documentation and if I have furnished 3CB, but there is a TP adjustment, there cannot be any penalty for concealment of income because the definition itself has changed. It is under-reporting or misreporting of income. So that is the summary. And last but not the least is 271 AAD. This section was introduced a couple of years ago, which basically says that if you have a false entry in the books of account. And what is the false entry? They are saying invoice issued without actual supply of receipt or receipt of goods or services could fall under false entry. Now look at a situation. You have made a payment. An Indian company has made a payment for intra-group services to the group. The TPO says that I don't believe that you have received this service, and he computes the arm's length price as nil. This is a situation where there is a potential where the assessing officer may say that this is a false entry because you have not received service, and therefore I will levy you a penalty under 271 AAD, and that penalty can be equal to sum of such false or omitted entry. So that is the summary of penalties. I will just look at question. In case of SDT, whether transaction between private limited and partnership, everything is covered, Chetan. You need not look at whether it is partnership or proprietor or all of that. Because for SDT, you have to look at 2 categories. Either it is intra-unit transfer or it is a transaction with close connection. Now, if close connection, attracts the private limited and partnership or proprietor, all of that will get covered. By the way, for TP purposes, person is a person, and person would include individual, AOP, BOI, partnership, permanent establishment, private limited, Indian registered, overseas registered, all of that. So therefore, everything will get covered, Chetan. Sudhi, you have a question, can AO levy? No, it can't happen, no, Sudhi, because these are different years, no? 271 1C is applicable up to AY 16-17. 270A is applicable from AY 17-18. So it can't be overlapping, no? Yeah, no problem. So any questions before we move into what is the next area? Yeah, use of CbCR and master file before we move into that. Okay, I assume that as no, and let's move to. So like I mentioned some time back, this CbCR master file will be filed with Director General Risk Assessment, which is DGRA. Both of these are filed to DGRA. DGRA will share it with the overseas tax authorities wherever India has automatic exchange of information agreement, and he can share that CbCR with those authorities. DGRA has something called centralized risk assessment unit, which will do all the ratio analysis that I talked about. And that CREU will provide inputs on the BEPS risk to the TPO. However, TPO will have to undertake extensive audit to evaluate whether these BEPS risks are real or there is or these are only misunderstandings or misinterpretation related aspect. So OECD has very clearly said that the CbCR as well as master file cannot be the basis to make TP adjustment. You can do high level TP risk assessment, especially the BEPS risk assessment, and then you have to do the substantive audit. The confidentiality has to be maintained, and therefore if the TPO asks you for a copy of CbCR, unless those, except the cases that are covered under section 286(4), but if you're not required to file CbCR in India, your group has filed, India has the exchange of information agreement, then even if TPO asks you for a copy of CbCR, you can simply say that we cannot provide that to you because you do not have the jurisdiction. Similar is the answer to the master file. You need not submit master file to the TPO because the clear guidance, and this is CBDT instruction number 2. So you can quote this instruction itself because this is a protection as per the guidance provided by OECD in Action Plan 13. I think we have covered this. So the CbCR and master file can be used by this central risk assessment unit. They will try to use various ratios and they will try to see whether there are any alarms. So what are the examples of adverse ratios? So if you have a very high third-party revenue, but very low profit before tax or very low ETR, how do you compute ETR? Tax accrued divided by profit. So you have ETR. So and minimum marginal rate. So which is basically normal tax rate. So if you have a very low tax rate, very low profit before tax and high third-party revenue, probably there is a situation that that the group has done a significant amount of either royalty charge or intra-group service charge or some other charges with which they are trying to take out the profits. So that is, again, like I said, this is only an indication. This cannot be conclusion to make a TP adjustment. What is another situation? You have very high third-party revenue, high profit before tax, but very low effective tax rate. That means they are trying to play with some tax rate, and probably this could be this is an example of your ATI 10. No, not ATI 10. Basically, where you are earning profit which is more than ordinary profit. So this is that kind of example. If you have high related party revenue but very low PBT, there can be a BEPS risk. If you have high related party revenue, high profit before tax, but very low ETR, again, there is a possibility of BEPS risk. If you have, and these are examples, huh? You can be as creative as you want. I give you that Mauritius example, which is a classic example, which could lead to significant amount of risks that could be seen. And then you have master file related data. What are the important service arrangement? What are the business restructurings that have happened? What are the intercompany financial activities? And all of these, which are these qualitative details, can be used to corroborate a BEPS risk. So maybe we have reached almost, let's say, 60% of the overall session. But if there are any questions, if there are any doubts, I'll take a pause. I need to take a sip of water. In the meantime, if you have questions, please ask. I take that as no questions. Okay. So how many of you have worked on Form 3CB? This is my way of checking whether all of us are attentive. No, you can put in the chat box instead of raising hand. Otherwise, I will. Can I get a yes? How many of you have worked on Form 3CB? Yes and no as answer. Come on, I am getting so less responses. Are you guys all attentive? I have got what, 10 responses out of 57. The rest of us, are we all around? Okay. Prasanna Pangam, 2004, you have started. So I'm sure you have worked on TP. Okay. There is a query that has been, somebody has raised the hand. Venkataratnam. I don't know whether I'm pronouncing your name correctly. If you have a question, you can unmute yourself and ask the question. Venkatratnam. Okay, there are two people who have raised hand. Can you please, Yatin Kumar has raised.
Yeah, can you hear me, Amit?
Yes, yes, Yatin.
Yeah, that question I have asked regarding private limited directors information. What I'm asking is, in a practical situation, private limited company has done director of private limited company, which is providing software solutions. It has entered into a one of the transaction, one or two of a small transaction with a USA entity in which that director is also a 50% partner.
Okay.
So for that small transaction, which is with the foreign JV, this private limited has to do all this TP requirement and all this documentation and etc. Right? Because there is no limit of 1 rupee.
So Form
And,
3CB has to be obtained. TP documentation,
yeah.
if it is less than 1 crore rupees, then maybe you have to maintain some documentation with which you are able to prove that the transactions are at arm's length. Master file, at least part A, you will have to furnish any which ways, and CbCR notification.
Yeah, I understand that, but what I want to ask you is, these all are very much very much hectic compliance for a small private limited company. So what practically we have decided that we will take from director that there is no interest in country of that director. So as a
No,
private
no, no,
limited
no, no,
company,
no, no. That's
so
a
is
very
it
risky. No, no,
advisable?
no.
Yeah. Okay.
It's absolutely risky, because even if
Okay.
you take
Okay.
representation, the company, you're putting the company at a penalty risk.
Right.
So,
So I'm talking about company's point of view only, because to say save the compliances of lengthy, because what I am under impression is that how that Indian tax authority will come to know about that small JV in which this director is a partner. That is the
no,
only.
see, in the personal return also you have to report what are your foreign assets, right? So the director
Right.
himself in his personal return of
He's
income.
an NRI. He's an NRI and he's not filing return here.
So see now, I will not comment upon the threat of detection. Okay, I will only talk about what are the compliances required. Now,
yes, that I understand. Just
tomorrow if
for
there
a
is
practical point of view.
see, practical has to be, so you have to evaluate the risk. Now, the point is that there is a compliance that is required. If you're not doing the compliance, there is a risk.
Yes, yes, of penalty and all.
All these and penalties can be 2% to 4% of aggregate value of international transaction. If there is a TP adjustment, the penalty can be as high as 200% of the tax on the TP adjustment. So you do that evaluation, and accordingly you evaluate. As an advisor, if I'm the advisor, I would personally not advise the company not to do the compliances. It has to be their call, and then they need to be aware about the penalties.
Right. That is what I am. From practical point of view, I am just asking, so I can guide them regarding this consequences.
I think the penalties are very draconian, and see, these numbers can be mind-boggling, right? Because see, you're not talking about tax value. You're talking about value of international transactions. So with that shareholding, if the transaction is 100 crore rupees, you look at what can be the penalty.
Right. No, transaction is only of rupees, say 1 or 2 lakh, and only single or two transactions.
That is a call. Then that's a call that you would take.
Yes. That is why I'm using the word practical.
But penalty, but the penalty cannot be ruled out.
Okay, fine. Yeah. Okay. Thank you so much.
Any other question before we move to practical aspects and nuances of Form 3CB? Somebody else also had raised hand. Venkat Ratnam or somebody. Okay, so let's get into this part. And like I said, I have a hard close at 7, so we'll try to finish. But these are very interesting questions. So I think first question we have already answered. Let's talk about penalties. Okay, so there is one section which says that failure to furnish Form 3CB 3 lakh rupee penalty, and 271 AA1 says that if there is a failure to report a particular transaction, then there is 2% of value of international transaction penalty. Can both of these coexist? Quick answers in the chat box. Yes, no, yes, no. Only one answer? Okay, so we have some views here, right? So see, the point is now, can I say that then, like our friend sometime back said that, I have not reported only. So then my exposure is limited to 1 lakh rupees. So somebody who has dutifully obtained the Form 3CB, but let's say missed to report a particular transaction, he has a penalty which is 2%, which could be much higher, because I'm assuming the transactions will be in few crores of rupees. Whereas somebody who has not reported, not obtained Form 3CB, you're talking of 1 lakh rupees penalty. So can you really go away, or can you excuse yourself from such a high penalty? There is a question mark. There is no guidance under law, but I am of a view that these two are independent and the lawmakers have thought about it, and therefore these two are independent penalties and they should coexist. Yeah. Then, okay, let's look at this. What is more onerous, true and fair or true and correct? From a reporting standpoint. Can I get answers? Yeah, absolutely right. In my view, true and correct is more onerous from a reporting standpoint, because any small deviation in the amount could render this true and correct as questionable, whereas true and fair is overall view on the financial statements. So I agree to that extent, and Form 3CB is true and correct. We have handled tax audit reports also. There also it is true and correct. Then CA opinion. Is it possible to qualify or disclaim the opinion in Form 3CB? Yes, no. There are a set number of participants who are giving answers. Huh? Can I expect answers from all? We have 55 participants. Okay, yes, you can qualify because it is a report by an accountant, and you can qualify or disclaim the opinion, and therefore, I mean, there can be notes to the Form 3CB, and we'll talk about that. Revision of Form 3CB, is it allowed? So Govind Agarwal is saying no, Bhakti is saying yes, Sudhi is saying yes. We are still getting 2, 3, 4 people only who are answering. Anyway, so see, there is no provision under law which allows revision of Form 3CB, but there are practical aspects where you may, because it is true and correct, you may still want to correct the errors if there are any. And more importantly, if you go to the tax portal, then they ask you when furnishing Form 3CB whether this is original or revised, and therefore, in a practical sense, the department also is aware that Form 3CB may be revised, and from that perspective, the revision of Form 3CB is practically possible. But we don't know if a transaction is missed to be reported, and if you have corrected that, whether authorities would say there is this revised 3CB is not the legal document, and therefore we will look at original, and therefore we will levy penalty. There are no case laws till now for that, but probably that also could be possible, because there is no legal provision that allows you to revise the Form 3CB. Notes to Form 3CB obviously are very important. How to file is a practical challenge, because there is a particular small space that has been given, whereas the notes can be much more. So a practical answer to that could be that you file the Form 3CEB along with notes in a hard copy with the assessing officer, either immediately after uploading the Form 3CB or when the assessment gets picked up. So I'm sorry, there is a repetition of this question, so I'll skip that. Foreign entities, whether Form 3CB is applicable? Quick answer. Yes, no. PE of foreign entity is required to file, which is very clear, Sudhi. That is not the point. So let me share a perspective on this. If the foreign entity has a transaction which is taxable in India, then they have to obtain Form 3CB and they have to undertake all the TP compliances. Because the section 92, which is the operating section, the machinery section for TP, it says income from international transaction should be computed having regard to arm's length price. So if for foreign company, if that income is taxable in India, then they have to obtain Form 3CB and file Form 3CB and also do all the compliances that are required. Now there is another interesting point, which is 115A, which says that if you have interest income or royalty income and withholding has been done as required by law, then you need not file Form 3CB, which is you need not file for return of income, which is okay, but there is no such specific exemption from TP compliances. And therefore, although you may not be required to file the return of income, you may still be required to obtain Form 3CB, still required to maintain TP documentation and do rest of the TP compliances. So this is another important point that is there. And typically this point is missed by many companies, many consultants. So it is important that you make your clients aware, and if you yourself are responsible, you should. Satish has a question. You can unmute yourself and ask. Satish.
Hello.
Yeah.
So, in many of the cases now, PEs are not available in the India in case of foreign entities, and they may not be available aware about the laws of India. So in that case, how can this 3CB compliances can be possible?
Yeah, so this is a very important question. So see, we are not talking about any and every transaction. We are talking about international transaction, which means that that foreign entity is part of the group, and therefore it is the consultant's duty to make them aware about the compliance is required, and it is also the duty of Indian subsidiary to make its parent aware, because you are doing the withholding. So when you do withholding, you communicate to your group that these requirements are there in law. Because you see, ignorance of law is no excuse. That we have learned in maybe a foundation.
So in majority of the cases which we see, allocation of the common cost, like acquisition of the softwares from the foreign companies.
Yes.
This is a very common thing that itself
Absolutely.
constitutes.
Absolutely. Absolutely right. If it is income for them.
But that
And
needs
on
to be
which-
assessed, because that is not just from the face of that we can assume.
Absolutely right. I completely agree with you.
Okay.
So if it is an international transaction, you have to do the compliances.
Okay. Thanks.
Yeah. Whether all foreign subsidiary to file Form 3CB, even though there is no transaction. See, 3CB is only for international transaction that result in taxable income. Okay. Now, if there is no, if there is only share capital, then there is a position that one could have taken earlier, that there is no taxable event. And therefore, Sriniket, you asked a question. So see, if issue of share capital is not a taxable event in itself for the issuer, and therefore one could take this position, but that was possible in the past. The recent amendment says that if you have issued the shares at more than fair value, then the amount which is in excess of fair value will be taxed as income in your hand, and therefore this transaction also will have to be reported. Okay, I'm talking about Indian subsidiary of the foreign group. Foreign subsidiary, I'm not talking about if there is no taxable event as such. Okay, now there is another important point. The law says income from international transaction. Okay, so if Indian subsidiary has issued share capital to the overseas group company, then that is a related party transaction, right? Now, they may be, in future, they may sell those shares. Even if they are sold to third party, there will be a capital gain that will get that will become taxable. Now, what is capital gain? It is basically sale minus purchase. While sale could be to a third party, but the purchase is a tainted transaction, and therefore at that point of time you will have to prove that the purchase was at arm's length. Because if it was more than arm's length, then you are probably trying to avoid the taxation in India or reduce the taxation in India. Therefore, there are two options. One option is that when the shares are purchased by foreign entity, that time only you obtain Form 3CB and demonstrate that it is at arm's length. Or at the time of sale, you do that, but that could be after 10, 15, 20 years. And that point of time, you may not have access to details, so on and so forth. So but basically there is a capital gain, and capital gain involves sale and purchase. And if purchase is from a related party, obviously you will have to demonstrate that the purchase was at arm's length. Next question, Govind has asked, in future, department can exempt flipside entity, foreign entity from 3CB, like they have exempt. Yeah, they can do that, Govind, but right now it is not. So as we speak, the law says that for foreign entities also have to file flipside return of income. Yeah. Any other question before we move to the next points? Okay, we have a lot of area to cover. So let's move to, so associated enterprise, if you look at section 92(1), which it says, if there is a relationship of management, control or capital, then participation in management, control or capital, then it is related associated enterprise. And 92(A2) says that for the purposes of subsection 1, and then they have given some A to M related examples. Now, the question is that, should we restrict ourselves to these examples that are there, or should we say that there can be something else additional that could be there? This is the main question. There are interpretations, but basically, 92(A1) is a broader thing. 92(A2) says that for the purposes of subsection 1, following are the situations which are deemed to be associated enterprises, and therefore from that perspective, my view is that 92(A1) is larger and 92(A2) is an example, and therefore there can be situations beyond 92(A2), but there are some interpretations which say that 92(A1) has to be read with 92(A2), and therefore there is nothing remains beyond 92(A2). This is a hyper technical point. Those who have worked on TP would understand. The number of units in various clauses, if it is not possible to provide, you can always say that these are practically not possible. These are various, because for various clauses there are these requirements. Then let us look at situations where the taxpayers have obtained APA or have opted for safe harbor. Whether they have to still obtain Form 3CB, the answer is clear yes, because there is no exemption from these requirements. So basically, absence of specific exemption is the real reason. Then maybe let me ask this question, whether, and please give answers in yes or no, whether the transaction should be reported with the amount which are inclusive of GST or excluding GST. Quick yes, no. Excluding, including, there is only one including related answer that has come up. But see, including is not the right answer, because the GST is payable to the government. That is not a transaction with related party. You may raise invoice, but that is an incidence. And that is not really transaction with that related party. It is a consequence of the transaction which you have to pay to the government. So you report, and more importantly, again, you look at it, the GST that you will charge will go to the liability side of balance sheet. Whereas here we are talking about income from international transaction. So something that impacts the P&L account. Non-taxable transactions, whether they should be reported. Yes. Okay. So see, if it is not taxable, there are case laws which say that Chapter 10 itself doesn't apply. So if you have a transaction which is not taxable in India, then Chapter 10 itself doesn't apply. And I agree to that view, because Section 92, which is the machinery section for TP, it says income from international transaction should be computed having regard to arm's length price. So if a particular transaction is not taxable, let me give you an example. Dividend paid. So for recipient, it could be taxable. That's a different story. But dividend paid is a below the line transaction. Then if I don't report that and it has no impact on my taxable income, then I need not report that. So I just give one example. If the transaction is taxable under Act but is exempt under DTAA, would reporting requirements still be there? So the reimbursement has a different connotation. Reimbursement, somebody is claiming the deduction, and therefore it has impact on taxation. Therefore, reimbursement are to be reported. Yeah. Yes, the answer is yes. That if because you have to give an opportunity to the tax authorities to evaluate your eligibility to claim the DTA access, and therefore there are case laws which say that if the transaction is, and that applies to return of income also. Satish, you have a question. You can raise. You can unmute yourself. Ask the question. Okay, in the meantime, I will proceed because we have another 15 minutes of the. Satish, if you have a question, you can pause and unmute yourself. Ask the question.
Can we have some more example about not to report need to report non-taxable transaction? The dividend, you said one example. Are there any few
Yeah,
more
so
examples?
let me give you an example, Satish. You have a so Satish, you have a foreign entity which does not have permanent establishment in India, which does not have taxable income in India, which does not have business connection in India, but they have sold goods to a related party. Then that transaction is not taxable in India. Therefore, for that foreign entity, you need not report that transaction. So if a foreign entity has only transactions of purchase and sale of goods with Indian entity, with no taxability in India, then you need not report these transactions. What you would, however, report is if they have earned royalty and that royalty is taxable either on a gross basis or on a net basis, or if they have earned interest, or if they have earned service fee, so on and so forth. Does that answer?
Yes, I think that is okay.
Yeah. So Nitin, you are right that if the transaction is not taxable and then if it is not reported, then it will not be termed as non-reported. So don't worry about it. Now let us look at purchase of asset. So you have clause 11C. So purchase of software, you will not report it under 11C because that clause is purchase of fixed asset, whereas clause 12 is transaction with intangible property. So purchase of software will go there. Transfer of capital asset at WDV, whether it is acceptable arm's length principle, the answer is no, because the market value could be higher or lower than WDV. WDV is your method of accounting, the method of depreciation, and that cannot be a proper indicator to say that the transaction is at arm's length because I have purchased it at WDV. Whether you can use TNMM as the most appropriate method for import of capital asset, my view is answer is no, because you are testing only depreciation. TNMM is net profit evaluation. So you are basically comparing the net profit of the tested party with the comparables and then concluding whether the transactions are at arm's length or otherwise. Depreciation is only a portion or a fraction of the capital asset, and you don't have a clarity that for lifetime till the time of the asset, till the time the depreciation becomes zero, you will use TNMM. Therefore, this may not be the most appropriate method. Capital work in progress or goods in transit, you should report because that has an impact on asset liability and that will have impact on taxable income. So you need to report. Method would depend, I have seen cases where, these are reported as normal transactions and they are, clubbed with other transactions as such. Assets acquired under slump sale also would require, Nitin, reporting. Because you are going to claim the depreciation on those assets, which will have impact on taxable income. Yeah. Then use of SVB approval for import, whether can be used to defend arm's length nature of import, the answer is no, because SVB is completely different. SVB is under customs law. Customs law basically looks at a situation where basically their assertion is whether you have undervalued the transaction, whereas income tax says whether you have overvalued the transaction, because higher the value, higher is the custom duty, whereas higher the value, higher is the deduction, means lower is the profit, means lower is the income tax. So these are rather the forces that are pulling the transaction in two different directions, and therefore you cannot look at SVB valuation. Import of second-hand machinery, what is the most appropriate method? For under customs law, there is a clear requirement that for a second-hand machinery, the valuation report has to be accompanied with that. So that itself can be a basis, and you could use other method as the most appropriate method. We have 10 minutes. I'll try to cover the rest of the slides. Maybe last 2-3 minutes I'll try to. So for intangibles, the most appropriate method typically is other method. For advertisement, marketing, promotion, I think this is a complex question, but basically AMP is not an arrangement, and therefore you need not report that, but you could cover it by way of note. If at all you feel AMP is a transaction, then I would rather suggest to cover it under service clause rather than intangible related clause, because the assertion is that you are providing brand promotion services, if at all. Existing arrangement for use of intangible property but not charged by AE, you should still report because it's a free of cost transaction, and that may have impact. So even zero value is a value, and you should report that. So all free of cost transactions, all waiver, if you have a moratorium for interest for a particular for a couple of years, all of these should be reported, because all of these, if charged, would have impact on the taxable income. Services reimbursement with administrative markup, whether it is service, my answer is no. Therefore, you need not report it under clause 13, but it should go rather under clause 19, which is residual. Charge of expat salary, although from a corporate tax withholding perspective, this could be evaluated under fees for technical services, but one need not report it as service because it is not really a service. This is reimbursement of salary. Management service fee, which is indirect allocation, should be reported rather under clause 17, which is mutual agreement or arrangement, whereas because there is no direct service that is available, that is present here. Clause 13, if you have a pricing which is based on cost plus, then whether method is cost plus, the answer is no, because cost plus method talks about the profitability evaluation at gross profit level, whereas if you're looking at net profit level, then the method would be TNMM. So cost plus pricing is different than cost plus method, is the message that is coming out over here. Now, capital financing, this is basically for all these loans and all of that. Whether bank quotation are acceptable benchmark, probably yes, provided the terms and conditions are comparable, and you have to look at other method. So quotation are possible provided there is a comparability that you have. Whether loan amount needs to be disclosed every year, my answer is no, because loan is given once, and then repetition of that is not something that is expected. The coupon rate benchmarking need not be done. Coupon rate or interest rate benchmarking need not be done every year, because even if you go to bank, you agree for interest rate for a particular period. Albeit it could be linked to a LIBOR or your SBI prime lending rate, etc. But basically you agree the interest rate once for the entire tenure of loan. Therefore, benchmarking every year is not required. Interest-free loans in case of loss-making companies, is it shareholding activity? There are case laws which say that no third party would give loan to any third party, even if they are loss making, and they will not charge interest, and therefore interest should be charged, and there is nothing called interest free loan. That means there is some kind of mispricing that has happened. If there is a moratorium that has been provided, typically even banks try to recover the interest in the balance period, and therefore that moratorium, even if you're in the year of moratorium, should be reported, because that has impact on taxable income for the future years. Trade receivable payable, if these are overdue and these are deferred trade receivable payable, then as per the definition itself, these could get covered under capital financing arrangement, and they should be reported. For normal trade receivable payable, you need not report them, because these are consequence of the original transaction, which is your purchase sale transaction. Therefore, they need not be, but they should be reported by way of note, because there is this draconian penalty of 2% of value of international transaction not reported. If you have return of interest, which is receivable, whether that needs to be disclosed, the answer is clearly yes, and rather you will struggle to demonstrate arm's length nature of that. Probably if the borrower has undergone some kind of insolvency or bankruptcy, then maybe you could say other method. But otherwise, you would typically find it challenging to ensure that these are at arm's length. And whether repayment of loan needs to be disclosed, the answer is no. See, we have various. We have 5 minutes. If there are any questions, rather let me finish these pointers so that you have at least a perspective. So guarantee, letter of comfort, performance guarantee are not explicit transactions. You are not undertaking any kind of liability, and therefore that need not be reported, but some kind of note is always welcome. Guarantee amount disclosure every year is not required if no guarantee fees charged. Whether the transaction should be reported, the answer is still yes. The method you will struggle, because in a third party situation, nobody gives guarantee without charging a fee. So rather it is important that you charge some kind of guarantee. Whether guarantee can be considered as a shareholding activity, there are arguments, but the practical answer is no, because nobody would give a guarantee without without some kind of remuneration. Whether quotation from banks can be used, I think the answer is same, that yes, it can be used provided the terms are comparable. Repayment of loan based on invocation of guarantee by bank, whether it is reportable transaction, my view is no, because that revocation or invocation is happening on account of the guarantee transaction. It is not a transaction with related party. The transaction with related party is transaction of guarantee. Repayment of loan is a consequence of that. I think shares we have discussed, so I will not spend time on this. We have already discussed cost allocation. Also, we have already discussed business restructuring should be reported. There is no amount. Therefore, you may have to go to clause. If you look at clause 18, there is no amount that has been mentioned. So you may have to report that under clause 19. Even if it is a transaction between two non-residents, still, if the nexus or situs of asset is in India, you may still have to report that in India. Then you have any other transaction. So free of cost transaction should be reported. ESOP cost recharge should be reported. Dividend received should be reported because it is taxable. Dividend paid need not be reported, although you can always provide a note. Deemed international transaction is an interesting area, but you will have to report it because there are draconian penalties. If it is only an arrangement, from a quality perspective and negotiation is not happening, then probably you need not report that. I think, yeah, with that 3 minutes we have. If you have any questions, I'm happy to answer. Yatinji, you can answer. You can unmute yourself and ask your questions. 2 minutes we have. I will have to
just got confused regarding this non-taxable reporting and taxable reporting you just mentioned. Particularly if an Indian listed entity has two subsidiary in, say, Dubai and UK, they are doing the transaction of export commission as well as sale of goods and purchase of goods.
Yeah.
Both.
So does that transaction have a bearing on taxable income of Indian entity? Answer is yes.
Yes, if it is sale and purchase, yes.
And therefore it will have to be reported. So there is no question of non-taxable. But let's say if India acquires shares in that overseas subsidiary, is that a taxable transaction? No.
No. Yeah.
Therefore, that need not be reported.
Okay. And this regarding dividend received. Dividend received is the income of Indian tax entity.
Of Indian entity, therefore it has to be reported.
But it has no control over the declaration by the overseas entity. Then how it is reportable and how it is?
So that is a different point, and we can have a different discussion around that. But because it is taxable, it has to be reported. How to compute arm's length price? Probably you may have to say that it is as per law, as per the company law of that respective country, and therefore we will have to.
Okay. Correct. Thank you.
Last question, Satish, if you want to ask a question.
Yeah, so you said that Indian for a parent company which is holding shares of subsidiary company, okay, those transactions are not reportable. But if suppose tomorrow Indian parent company has sold those shares, then that amount is going to be
Yes.
taxable. So
Yes.
that's
So I think that we discussed, right, Satish, that at the in the year of sale, maybe you may have to report. So you have to demonstrate that the income from international transaction is having regard to arm's length price. In the year of purchase of share, actually that is not a taxable event, because there is no tax that has been that gets.
you mean to say when the year in which it is crystallized, only that year we have to make the compliance, because
Yes.
transactions nature is quite like acquisition itself a crystallized point for we are known that is certain to going to get the profit.
Satish, I covered this point that either you report in the year of purchase or you report in the year of sale.
Okay.
Okay. Bhakti, last question. We will have to.
Yes, sure. So during that discussion of foreign 3CB, what I understood from the discussion that when there is income by way of only FTS and royalty, tax is deducted as per Income Tax Act, and so the these entities need not file return of income over here. But 3CB compliances are to be done. But if entity is not taking PAN, then there is a challenge of filing 3CB.
So you should rather tell the client that you obtain Form 3, you obtain permanent account number. Because if they have to do the compliances, obviously you need to get. So see, if the foreign entity has taxable income, then they have to do TP compliances. For TP compliances, PAN is one of the requirements, because you can't upload Form 3CB without obtaining PAN.
Yes.
So you have to obtain PAN.
Oh, thank you.
Okay, all right. Thank you so much, everyone. It was a great marathon session. Lot of interaction, lot of queries, and I hope I've been able to answer. And I enjoyed interacting with all of you. Thank you so much.
Sir, everyone enjoyed the session because it was totally, you made it interactive. Usually we take questions at the end, but the way you have resolved the issues, I think it made it very interactive.
Thank you, Rajesh.
Thanks a lot, sir. Really, I should say it is an excellent and very active session. And also the same views of all the participants they have mentioned on the chat box. On behalf of Pune branch, I thank Amit Dhadphale, sir, for accepting our request to take the session, enlighten us on the topic, and also to all the participants for their active participation, and to my technical team who has supported us to complete this session. I think we can share this PPT, sir, with the participants.
Yeah, I will share that.
Yes, sir. Thank you, sir.
Okay,
Your query we have already resolved. We will get the PPT and we will upload it on the website.
Sure. Thank you.
Thank you, sir. Thanks a lot.
Thank you. My pleasure. Bye.